best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
You're listening to the Financial Survival Network. It's Kerry Lutz, and theme for today is oil and diamonds. We have Jason Stevens over from Sprott Global to talk about it. Jason, welcome back. It's been a while.
Yes, it has. Thanks, Kerry.
Hey, so oil, a lot of speculation. Some people say price is going to come back very quickly. Others say that it's going to be years. And from what I'm getting, I think you come someplace in the middle. What's your take, where we are, where we're going?
Well, there continues to be an oversupply from the 2004 drilling inventories here in North America. So that inventory will continue to flood the market, I think, until the middle of this year. Once that dries up, I think it dries up very quickly. I would suspect that we see a lot of the rig counts drop even more substantially than they already have into June. By the end of the year, a lot of the budget cuts that need to be made will be made on overzealous companies' balance sheets based on their credit cuts or their credit line cuts. So going into the end of the year, I think that a lot of the excess drilling will be cut for growth and sustaining some of these unconventional areas like the Bakken, like the Eagle Ford. So I suspect by early part of next year, we probably see $65 to $75 oil just that quickly, and might not feel quickly for people who have invested over the last 2 years in oil, but substantially quicker than many people and I think the largest companies expect it to come back.
Well, if that happens, then all of a sudden fracking becomes pretty much economically feasible again, doesn't it?
Well, I don't think so. I think a lot of the more substantial fracking operations are pretty darn marginal at $70 a barrel. So I think that's what Saudi Arabia meant to cut out of the equation when they sustain production at these at the current levels, is that they wanted to get rid of the marginal oil and gas producer in North America. We don't need $40 a barrel to get rid of those marginal producers. We literally need 70, 75.
Mm-hmm.
So I think one of the biggest concerns should be that a lot of these companies were over leveraged at $90 and $100 a barrel. So the E&P or the exploration production focused businesses that were 2 to 6 times in debt over their cash flow, those are the companies that are going to have big problems coming into the middle of the year. So just because I think oil prices will come back by the end part of this year, there are going to be substantial problems with the E&P industry throughout the whole year. So,
all right. Well, but in Texas, you can frack. Texas, Kansas, even in Oklahoma, you can frack well under $70 and still be profitable. But up in North Dakota, it's a bit more costly. Depends on the geology of the area.
It depends a lot. Yeah. Depends a lot on geology. Depends a lot on if there's a camp already set up. So there are a bunch of expansion wells or new areas that are kind of held on the balance sheet as proven undeveloped areas, but the cost of capitalizing those areas is much higher than I would expect that the areas you're talking about in Texas are. So if there's a camp already set, very low cost of entry to new wells, but stepping out to new areas where there's actually growth in production, I think that's gone unless we see much, probably closer to $80 a barrel.
Mm-hmm. Well, the other thing that maybe the Saudis weren't thinking of is that these countries that are facing financial ruin, they went and they were pumping every single barrel of oil that they could. So what actually happened was that rather than production decreasing, production actually went up, and that further drove the price down. So it's kind of paradoxical effect of lower prices rather than decreasing supply, actually increasing supply.
Yeah, and I heard a statistic, or I think I read a statistic, that outside of the OPEC nations, that only 3% of the world's reserves were economic at $70 a barrel. So that tells me that we're going to need to see higher prices to see dramatic increase in production from where we, I think, settle out in. I suspect that the kind of the balance point of today's demand supply issue, meaning a completely flat market, is around $62 to $65 a barrel. So that simply keeps prices flat and supply demand reasonably balanced. The longer we see oil prices below 62 to 65, I think we see a higher recovery over that level for the rest of the kind of the balancing out period.
Mm-hmm. Well, it's going to be interesting to see what happens, because I just can't see prices staying this low for that long a period of time. Of course, you go to fill up your car at the gas station. It's a nice feeling to see gas less than $2 a gallon in certain states. It's not in every state, but the fact is not really great for the economy. I mean, it's a kind of crazy world. Used to be high prices were bad for the economy. Now high prices are good for the economy, but yeah. That's
what an indebted nation gets. When prices go higher, it's good for people who are depending on those higher priced collateral assets. Yes. So obviously we've collateralized everything. So asset prices have to go up in order to keep our debt good.
Yeah, that's what it comes down to. And the jobs, the only source of new jobs really in the country, aside from flipping burgers, I guess, are in the oil patch and associated industries. And when the value of those assets goes down, there goes the source of new jobs in the country as well.
I think even those burger flipping jobs pay much better in those oil patch areas. So the higher dollar paying jobs, which are going away thanks to the drop in oil prices, affects every level of that microeconomy in these areas. So not only are your high-paying jobs going away, which could be replaced with things like the Keystone Pipeline, but you have less employment in general. So all of the employment that came online is now going offline, and the jobs decline in pay.
Yeah, it's funny. Have you ever watched that show Hotel Rescue? The guy goes up to North Dakota to, I think, Dickinson, and he's there to rescue this motel. And it's a really crummy motel. And the guy is making $600,000 a year off this motel from oil workers living there. And he really has no inclination to improve the place. There's all sorts of awful things going on there: prostitution, drug dealing, you name it. The place is just disgusting. And guy says to him, well, what are you going to do if the oil market, tanks? And, oh, that's not going to happen. And this happened. This must have been filmed like 6-8 months ago. And the thing got showed like 2 months ago, and sure enough, right when it was showed, the market was tanking. So it's amazing how when a trend happens, nobody wants to think that the trend can ever end. But in Dickinson, North Dakota, the trend ended, and now they're scrambling, and It's bad news. So it's just funny the way trends work. So for oil and any recovery, is there any bright spot in the U.S. Market for the recovery?
Oh, absolutely. I think there are a handful of companies. The biggest concern, so here at Sprott, obviously we make money by investing in companies. So I think a dramatic drop has happened. And if you're a contrarian in this market, you have to be looking at energy companies. One of the safest ways would to be looking at the integrated oil companies that make larger margins in refining and kind of their marketing sides of their business, and which compensates for a lot of the E&P business. But then you start to move down the quality scale, and you do have companies that were under leveraged in the E&P businesses, and you also have companies that are debt free. Believe it or not, there were a couple of guys that controlled a lot of land in the Canadian oil patches, and they have no debt. So they of course, the revenue goes down, but they can sustain that because the lack of leverage on their balance sheet. So there are bright spots. You just need to be diligent enough to go look through the balance sheets and look through the different companies that are operating there.
So the ones that have survived the current downturn in good shape with good balance sheets are really going to profit once the price goes up. And if they were wise enough to hedge their bets back a year or two ago and were actually able to get through this unscathed, then they're really going to cash in, right?
That's a great point. One thing that will save and kind of prolong a lot of these companies is that there are companies out there that hedged anywhere from 30 to 50% of their 2015 and 2016 production at $95 to $105 a barrel. So that adds a lot of leeway to their balance sheet, and they can sustain certain credit line cuts to pay down their credit lines when the reserve reports come out in Q2 of this year. So what I mean by that is that their oil, which is used as collateral in the ground, when oil prices go down, the banks that have lent based on those oil assets also have to decrease the credit line based on the lower prices of those oil assets. So a lot of those credit lines may go from $100 million to $70 million, and these companies will need to come up with the $30 million to come good on the credit line. And the companies that have the flexibility, the money coming in, especially if they're hedged, they'll have a little extra cash to throw at the credit line, so they're solvent and they don't have to start selling, which we will see anyway, kind of distressed assets in the middle of the year. Now, I think you have plenty of time as an investor. I think you can start nibbling at some of these well-priced and well-positioned producers, but you're going to have time to take positions in these companies, I think, well throughout Q3 of this year. So you will be ready for any sort of recovery in price early to mid next year.
Interesting. And yeah, I think it's a great way to get set up and be ready for the eventual recovery. If you're a few months off, you're a few months off, but inevitably the recovery is going to come. Oil patch full of booms and busts. Just look back over the past post-World War II period, and you just look back since the 70s, and it's there for all to see. Hey, when we come back, we'll be talking about diamonds, what's going on there, the market. It seems to be going crazy. Certainly has performed a lot better than gold and silver on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
We're talking with our good friend Jason Stevens, and we're talking now about diamonds. So, Jason, diamonds, not just a girl's best friend, huh?
No, an investor's best friend as well.
So how do we take advantage of, besides actually buying investment grade diamonds?
Well, so when I first started at Sprott, Rick Rule told me, one of the first things he told me was how risky the mining business was. He said 1 in 10,000 geologic anomalies actually becomes a mine. Now that number's been played with a little, but I would suspect that if you applied that to the diamond business, it would be more like 1 in 100,000 kimberlite anomalies becomes a diamond mine. There is about 25 to 30 mines in the world that matter in diamond production. And while diamonds are not necessarily rare, gem quality diamonds are. And these are like investment grade diamonds. They're a whole different asset class by themselves. But the problem with mining business now, the diamond mining business, is the fact that there's gone about 20 to 25 years without a major discovery. The latest discovery was in India. I believe it was by Rio Tinto, and that production probably won't come online for at least on average. In the mining business, it takes about, or in the diamond mining business, it takes from exploration to production on average 14 years. There have been mines that have taken 40 years to get to production, and then Mountain Province Diamonds is actually developing a mine in Northwest Territories, and it's taken them well over 20 years.
Really?
They should be in production by 2016, and that's the only substantial amount of quality diamonds that will be coming onto the market, I think, in the next 5 years.
That's amazing. And in fact, they're closing other diamonds in Australia, in South Africa, right?
Yeah,
Mines are closing up.
And there's big capital expenditures to South African mines. Not only are like Diavik and Akati in Northwest Territories, they're probably in their sunset years, so the next 3 to 5 years. But places or companies like De Beers are spending $3 billion, about $3 billion between them and the government to extend Zhuaneng's deposit in South Africa. So $3 billion to extend a mine, something like 3 to 5 years. So obviously the market is not only demanding these diamonds, but the whole business quality value scale is centered around the miners. The biggest profit margins are made in the rough production business. So it's not necessarily that you do the impossible, which is identify the exploration projects before there's a discovery. A lot of these companies fly under the radar simply because no one's seen a big discovery or success since Aber Diamond. So people forget what's not in their most recent memory. So people aren't running out there and making big diamond investments because nobody remembers a big diamond discovery or nobody remembers a big diamond stock success. So I think that's a huge advantage to those that are willing to be patient and wait for companies to take mines into production. I believe Lucara Diamond, which is the Lundin Group's mining company in, I believe it's Zimbabwe. I might be wrong in that, but it's the southern part of Africa. But they discovered 8 diamonds that went in auction that generated something like $140 million in revenue. Wow. So these are they're fancies, so they're large and they may be colored. I think some of them were blue, some of them were pink. So there's still a very high demand for the fancies and exceptionals. And that's where a lot of the investment grade diamonds are going as well. I've been told by I think a reputable source that Lucas Lundin is one of the largest individual buyers at the Antwerp auctions. So it's looked at as I don't want to say a store of value, but kind of an asset that can be moved very easily. $1 million worth of gold is heavy. $1 million worth of cash is not going to move anywhere. But $1 million worth of diamonds can actually fit in the palm of your hand.
That's right. Yeah, portability. There's nothing like precious stones for portability of wealth. That's for sure. In uncertain times, their value only goes up. And when you've got a crazy economy like we have now, where the 1% is looking for places to stash cash, diamonds, investment grade, the highest investment grade, they just keep going up.
That's a great point, is that we many times in the Austrian school obviously talk about the misappropriation or the misallocation of capital. And obviously the money gets moved towards the top 1% over time with stuff like QE happening and lowering of interest rates. Well, now that that's happening worldwide, I think it only gets worse over time. And if you add that along with the declining production that you're going to see after 2019, 2020, diamonds if the diamond business can continue to sell this, diamonds are forever, diamonds are a girl's best friend, diamonds equal love, that's the marketing ploy, and that's what is driving the Chinese and the Indians to be the highest growth demographic for jewelry diamonds.
Mm-hmm. Yeah, it's interesting that the way it's evolved, these colored diamonds have really become the stellar performers in the diamond market. And our sponsor, Tom Cloud, he just can't get his hands on these yellow diamonds. The blues and the pinks have just become so prohibitively expensive that only the wealthiest people can buy them. But the yellow diamonds, they're still down at like $5,000 a carat. Average Joes can afford them, but even those are getting incredibly scarce. Chinese are just gobbling them up. It's just amazing what's happened in that industry, and the investment properties just really. I mean, you really nailed an area that few people really know anything about. It's been really obscure, under the radar. So good catch there, Jason.
Well, thank you. And I think it is going to become less obscure as production goes away, because that's what happens is production goes away, prices go up, and the market becomes more efficient and drives the prices back down. I just think that's years, maybe even a decade away before you start to see a real efficiency increase in the diamond market in general. So that's an opportunity for today, as opposed to what we're seeing in many other commodities, which maybe we see prices lag because of the efficiencies of the market. So I think diamonds are going to be a great place to be. It's a matter of finding the right investment vehicle to take advantage of it.
Yeah, I think it's the diamond mine in is it Australia that comes up with the yellow diamonds, set to close by 2018. Mm-hmm. They're all closing, and it's just amazing that production has just not kept up. I know that De Beers kept a huge hoard to keep to artificially keep the cartel going. I don't know what their hoard is like now, but they didn't keep the hoard of the colored diamonds. That's a fact. And this mine, which is producing most of the pink and the blue, it's set to close. So I don't know what's happening there. It's producing over 90% of the world's supply of pink diamonds. So it's going to be interesting to see if alternative supplies are going to emerge. And hats off to you on this one. So, hey, people want to find out more about the research that you're doing, Jason, contact you. What's the best way?
They can email me at jstevens, Stevens, at sprottglobal.com. And then I also have a monthly newsletter that gives some of my own commentary and some of the most recent commentary out of the Sprott group about all sorts of resources that you can sign up for on our webpage, or I can give you a link to post under this interview. But certainly, if they'd like to receive that, it's totally free, and you have a way to get in contact me anytime if you'd like.
Excellent, and we'll have the link in the show notes to this interview, and check out financialsurvivalnetwork.com. Sign up for our mailing list, and got a webinar coming up in the not too distant future, and be there. Jason, thanks so much. Talk with you again soon.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.